apparently China has continued to buy, gold at a record pace. And moreover, they're trying to hide, which would suggest that they probably have a lot more to do. So from that point of view, I think, the World Gold Council report that came out last week was, both important and pretty bullish for gold.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 29th through May 6th, 2024, while supplies last. First, we feature 2023 1-ounce South African Silver Krugerrand at just $3.10 over spot. Next, backdated 1-ounce gold Australian Kangaroos are only $59 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is David Woo, former top Wall Street macro strategist. David, thank you so much for joining us today.
Thanks for having me.
Well, it's great to have you today. When we saw this rise in the gold price, you had been reporting on it, and a lot of people were pointing to different factors that were causing new all-time highs for gold, and you were saying none of those actually make sense at the moment. What's really causing this is escalating geopolitical tensions. Can you expand on kind of giving us an overview? What have we seen in the gold price over the last few months, and why really do you think it has risen?
I think, there are many factors, and I'm not even sure to what extent, in some sense, like my views are evolving as I see more data coming through. I think, obviously the big run up in gold over the last 2 months, I think, the market wanted to basically put it down to rising geopolitical risk. But I'm not sure that's actually the explanation because if it's geopolitical risk, then gold and oil should really be moving the same direction. And then actually, believe it or not, they really haven't, at least on a day-to-day basis, the correlation hasn't been all that strong, which actually, forces everybody to sort of look for other potential explanation. And I think, even though some of them actually is difficult to prove, and I'm starting to think that actually China has played a bigger part than I expected. I think, this is actually the big, I think, new news that came out last week, which was that the World Gold Council, I don't know if you saw that report, came out with actually a very interesting analysis in which they claim that actually China, we're talking about the Chinese central bank, has been adding gold more aggressively than their monthly data have, have suggested. And that's interesting because, we have various ways to get basically a read on Chinese reserve accumulation, basically in terms of gold. And the IMF actually publishes that, in the context of all the countries at the same time. And according to WCG, WGC, in fact, they claim, and I have to believe that they have some reasons to basically draw that conclusion, which is that China has been adding gold more aggressively and more rapidly over the last 3 or 4 months than actually the monthly IMF numbers would suggest. So I think that was like a bombshell when I saw it, because it was like, well, listen, because until that report came out, I think everybody, including myself, was doing the assumption that the pace of Chinese gold reserve accumulation was actually slowing based on the IMF numbers, right? Therefore, it was impossible to sort of put down the gold rally to actually China. But now, there is evidence to suggest that actually the IMF numbers were wrong. Well, rather the Chinese were going out of their way and trying to hide their activity, which is also understandable because the Chinese don't want everybody else to front run them, right? I mean, if you think about this, right? I mean, if you're going to buy a lot of gold and everybody knows that China is a massive player, if they're just talking about diversifying 1%, 2% of their reserves into gold, I mean, that's going to send gold sharply higher. So they have an incentive to sort of play down what they're up to. And we've seen that actually in the past, US Treasury basically buying by China in 2017, for example. We saw that China was trying to basically hide what they were doing by parking their, the Treasury holdings with Belgium, as opposed to typically with New York Fed But be that as it may, that's the problem when you're a very big guy trying to basically do certain things in the market and everybody's just going to basically front run you. So I think, but be that as it may, I think the story here is that apparently China has continued to buy, gold at a record pace. And moreover, they're trying to hide, which would suggest that they probably have a lot more to do. So from that point of view, I think, the World Gold Council report that came out last week was, both important and pretty bullish for gold.
And what's the motive for the Chinese central bank to continue to buy gold at an aggressive pace?
I think it's pretty obvious, right? I mean, I would argue that the trust between the U.S. and China right now is all-time low. And I think the Chinese are very, very wary of the U.S. doing to China what it did to Russia, which is to basically freeze out, Russian asset, right? I mean, I don't have to tell you, right? So I think from that point of view, we've had two, pretty serious visits by U.S. officials, just of the last month. You had Janet Yellen there, and then followed by another visit by Anthony Blinken last week. And Anthony Blinken's basically saying to the Chinese, the message was very, very wow. Anthony Blinken's basically said that you guys need to stop supporting Russia in this war. Well, otherwise, you're going to be facing serious punishments. So I think from that point of view, I think the U.S. decided to play hardball with the Chinese. I think China, on the other hand, there's no way, and then rightly so, China should not allow Russia to basically lose this war, because China also knows that if Russia were to basically lose this war, then China will be next. I mean, there's no doubt. I think at this point, the U.S. has crossed the Rubicon, under the Biden administration. This is a sharp departure from what happened under the Trump administration. I've always said, under Trump, the U.S. did not enter. It was the first time since Jimmy Carter, the U.S. did not commit new troops to a new foreign conflict. But whereas since Biden basically took office, the U.S. is fighting one war after another, the world is edging ever closer to World War III. So I think from that point of view, I think, the Chinese are just at this point, they're just completely, there's no trust at all. And, I think especially against the potential, major offensive that I think the Russians are about to launch in Ukraine to basically finish the war once for all, I think the Chinese naturally will be rather hesitant, that the U.S. will basically come down with them, with a ton of bricks. So I think from that point of view, better be early than sorry. And I think one of the ways that they've been trying to get out, in terms of reducing the exposure to U.S. assets, you see that every month they're selling more and more U.S. treasuries. And then naturally, they've been probably putting some of that money to work by diversifying into gold.
Your perspective then on dollar hegemony in this case, because there's a lot of people are talking about how, the U.S. froze Russian assets, and that has been, keeping a lot of geopolitical players, maybe making them concerned about what the U.S. could do next. China is obviously concerned here about, can they now freeze our dollar holdings? Your perspective on that, what does that mean for the dollar going forward? Is there actually a threat to dollar hegemony?
It's interesting because, I think in the short term, at least, and the short term can last a very long time, because, in some sense, long term, it's just a series of short term. I would say short term, ironically, the U.S. basically this very, very hawkish, Biden administration that wants to declare war on the whole world practically, okay? It's actually bullish for the U.S. dollar in the near term. Just think about this, right? By pushing Europe into basically this, let's go out and destroy Russia bandwagon. I don't have to tell you, Europe is now paying much higher energy prices, than before the Ukraine war. And there's no doubt, Europe, the cost to Europe is deindustrialization of Germany, which is still ongoing, So I would argue, if you think about this, the U.S. war on Russia and China, for one thing, has weakened Europe seriously. I would argue it's weakened Europe more than it's weakened actually Russia, because just look at the Russian economy is doing very well, and the European economy has literally been on its knees. So U.S. has been hurting its allies, and as a result, the euro has been weak, and sterling has been very weak against the U.S. dollar. Now, if you look at actually in Asia, right, Japan and South Korea, the two major U.S. allies, their biggest export market is China. And then because the US is basically forcing them to adopt, basically much tougher, basically policy vis-a-vis China through sanctions and so on and so forth, as a result, these countries have done not very well either. And as a result, those currencies have been very weak against the US dollar. So all in all, I mean, obviously the fact that the Chinese right now, they're facing potential more tariff from the US, more protectionist measures, and so on and so forth. The Chinese economy, which as you know, everybody knows, is quite dependent on export, is now struggling for that reason. So this is why the RMB is weak. So ironically, the US is kind of like, the US policy under Biden, as much as, like temporarily is shoring up US hegemony, actually, ironically, has actually helped brought about a stronger than expected dollar, at least in the near term. So from that point of view, like this is actually interesting because in some sense, this, and you could argue that's the reason why US, has managed to outperform the rest of the world in terms of the growth, of the last 24 months. Of course, on top of that, you also have had very, very expansionary fiscal policy under basically Biden. That's how basically supported US growth. But I think in general, in the very short term, so far, the US, basically foreign policy under Biden, I would argue has actually helped the dollar by weakening both US adversaries as well as US allies. And that is the key takeaway here.
Now, you've also mentioned with respect to dollar hegemony that people are concerned about other currencies taking over, but that can't really happen unless we see a rise in the value of other currencies. And you've compared, the main competitor, maybe the Chinese renminbi, you've compared the Chinese total debt to US total debt, and they're pretty much the same if you consider total debt, not just the national debts. So your perspective on that argument, do you think the dollar can be overtaken by any other currency, and why does the amount of debt with respect to the US and China play a role there?
Yeah, I think, listen, I mean, at the end of the day, I think obviously the world is divided between those who are pro-US versus those who are pro-China. I'm neither pro-US nor pro-China. I'm just looking at this basically chess game and trying to basically figure out who's got the upper hand, who's going to win. And by the way, there will be many, many rounds of this game to be played out over the next decade, 2 decades, and so on and so forth. So, there is no way you could, I don't think one side has such an upper hand that that this is just going to be a one-sided basically game. But I think for the time being, at least, I think, what a lot of people don't realize is that, as you said, if you look at aggregate debt, right, we're talking about government debt, corporate debt, and household debt. These are the 3 main sources of debt. If you add them all up and divide basically it by GDP, you get the total actually real debt burden, if you like, okay? What the degree of indebtedness of the entire economy, okay? And on that basically score, China has already reached US level, okay? And US is quite indebted, but no more indebted relative to GDP per capita in the US, because generally speaking, you find that richer countries are able to take on more debt than poorer countries for obvious reasons, because richer countries, that means that they have more leftover income with which they can pay interest on their debts if they so basically choose to. So in general, rich countries sit on more debt. China, of course, is still a relatively poor country compared with the US, at least, either on a PPP, per capita adjusted basis, or basically in nominal terms, and so on and so forth. And for a basically upper middle income country, which is what China is currently, Chinese debt is very, very high. Okay, so from that point of view, I would argue that actually China, relative to this income level, is sitting on more debt than the US. So from that point of view, it doesn't make any sense that China somehow is going to basically offer itself as, the alternative to the US dollar as a reserve currency. Because at the end of the day, if people are running away from the US dollar, it's because they're worried about, the debt buildup and then the incentive that future governments are going to have to resort to inflation or default and whatnot to basically deal with the debt problem. But if that is what you're concerned about the US dollar, you should be equally concerned about that as far as China is concerned. And certainly, like I can tell you that much is very, very clear. Like right now, if it weren't for continued intervention, currency intervention, basically by the Chinese government, most likely via, state-owned banks, the RMB will be much weaker right now than it currently is. And also, the only reason why the RMB is not even much, much weaker is because you've got capital controls in China. Right now, most Chinese basically, retail investors don't have the possibility to actually get their money out of China. Let's just say they decide they don't want to basically buy Alibaba. They want to buy Google instead or Facebook. That is not basically a choice that they have, okay? Because capital controls. So you could bet your bottom dollar if China were to suddenly remove these capital controls, like the RMB will collapse. So I think from that point of view, there's no way anybody can basically convince me that somehow the RMB is going to strengthen. Okay, at least I cannot see a way you could actually see a significant strengthening of the RMB. In fact, if anything, I would argue right now, the RMB needs to go down. Okay, in fact, I think, there's a problem in China. They need to lower interest rates. Interest rates are too high. There's no inflation, so lowering interest rates should not be a problem. The only reason why they haven't lowered interest rates already is because they are wary of further RMB weakness against the US dollar, which doesn't look good, okay, for the Chinese. So I think from that point of view, they are actually being held hostage by their aversion to a weaker RMB, but I think that shall pass, hopefully. But the bottom line here is that I don't quite see any currency to replace the US dollar right now. I do see over time, maybe on a 10-year horizon, I think, in general, I think we're in general moving from a unipolar to a multipolar world. It's just going to take much longer than people think it will. And then at the end of this new transition, and maybe we'll get there in 10 years, okay, there will be many currencies that will be, essentially that will be important. And maybe the dollar won't be the only one anymore. But the point here is that, as John Maynard Keynes said, in the long term, we're all dead, right? Right now, like if you want to make money, I wouldn't basically think too far ahead, okay? That's not to say the dollar is going to strengthen further from here. I actually think the dollar's probably peaked, actually, after last week. I'm very much of the view that U.S. growth is finally slowing. And as a result, I think, I've been very bullish the dollar through most of this year, but I think now I kind of feel like the dollar's peaked because I think U.S. growth has probably peaked. And then, and so the interest rate differential argument in favor of the dollar, I think is starting to, I'm not saying it's going to go the other way, but I think the upside for the dollar at this point is probably fairly limited. Whereas gold is actually still, to me, the most interesting alternative to the US dollar, if you like.
And mentioning that there have been people saying that, these BRICS nations, for example, China, are accumulating a lot of gold. Do you see gold or the BRICS alliance or, the BRICS issuing possibly a gold-backed currency being a threat at all to the US dollar?
I know that whole notion is completely ridiculous because there's just not enough gold in the world to back the money supply of all these countries. Okay, so it doesn't make any sense. And then also these countries don't really have an incentive to really create one single currency because okay, fine. So, how's it going to work actually? Because if you think about this, right? I mean, there's a whole literature in economics called the common currency area, right? I mean, so if you think about this, like the Eurozone, to create a euro, you had to basically get all these countries, there were many of them, even at the very start of the whole Eurozone project, to actually agree on certain basically economic objectives, debt to GDP ratio, trying to bring inflation to a certain level, and so on and so forth. In other words, that they were trying to encourage these countries to converge to the same economic paradigm before these countries then go ahead and adopt a single currency. The BRICS countries are so different right now. It just it makes no sense for me for them to share a common currency. Sure, if you're talking about just transacting in the RMB or Russia trade with China and RMB or India trades with Russia and rupee, that's not a big deal. That really isn't a big deal. But to go ahead and say, you know what, we're now going to launch a single currency to challenge the dollar, we're going to back it with gold and so on and so forth. For one thing, there's not enough gold in the world. Secondly, those countries are so different in terms of their fundamentals that it wouldn't be either feasible or even desirable for them to basically create a single currency. And because at any given point in time, that currency may be too strong for one country and too weak for another country. Just think about this. I mean, it's a total mess, actually, and this is why, the euro, after 20 years of its introduction, the euro is still struggling because of the, diversity and the heterogeneity among the countries who are part of the Euro club. And I think from that point of view, it just doesn't make any sense for the BRICS countries. So, I mean, people talk about it, but, it's just sort of like most people have never really thought through this proposal. I mean, I started my career at the International Monetary Fund. This is what I, do. This is what I did for a living for many years. And a lot of people have been thinking about these things for a very long time. And to me, it's not obvious why it makes sense at all for these countries to embark on this path.
What role then, or what interests you with respect to gold right now then, and how do you see it could possibly compete with the US dollar as you were saying earlier?
I think it's, I mean, gold obviously, right now, the biggest problem that gold has, of course, is the fact that, it doesn't pay any interest, right? Right now, you park your money in US dollar, you get 5.5%. And gold, you're getting 0. So that is a problem. I mean, but hopefully that problem is not going to become a permanent problem because, obviously, the economy is going to slow. I mean, either if you get a situation where like economy starts to slow for whatever reason, I mean, there's no way U.S. economy can sustain, this level of growth and interest rates for a very long time. In fact, I think, most likely 2025, we will probably see a pretty big slowdown because for one thing, if for nothing else, a lot of U.S. company borrowers, we're talking about corporate, debt issuers, they're going to have to roll over the cheap debt that they issued back in 2020, 2021, when they were able to borrow money for practically nothing. So I think, in that respect, we should start to see, credit spreads widening, credit costs starting to increase, okay, and therefore reducing, investment and hiring and economy slowing. And especially given the next administration, I think, it's unlikely that we're going to see anything like what we've seen over the last 3 years in terms of fiscal stimulus. Because even if Trump were to win, I'm not sure to what extent he's going to be able to have filibuster basically proof majority in the Senate. And I'm not even sure Trump even wants to basically go down the path of cutting taxes and so on and so forth, especially with the budget deficit of $2 trillion. So I think all in all, when the economy slows, interest rates come down, that's when gold is going to get, a bit of a boost. But I think the main driver for gold in the short term, though, again, we're not thinking, until the Fed starts cutting interest rates, I don't think, gold is going anywhere as far as U.S. investors concerned. In fact, if you see like GLD, for example, we've seen actually outflows from GLD, to the extent that I can imagine, like, U.S., if you're a retail investor in the U.S., you're getting 5.5% by parking your money in 3-month treasury bills. Like, why would you basically want to buy gold? Especially, you think, you can pocket 5.5%. But I do think that the driver of gold, this is why China as a driver of gold is interesting. The demand for gold is coming from China. It's not coming from the U.S., okay? It's coming very, very clearly from China. It's not just coming from the Chinese central bank reserve accumulation, but also coming from Chinese retail sector. Because right now the Chinese economy is struggling. Interest rates are very low. Bond yields are very low. The stock market has been very volatile. The property market has been going down. And then Chinese retail investors don't have the ability to invest abroad. So as a result, there has been a bit of a craze, okay, when it comes to gold. There's been a lot of reports about like retail savers walking to jewelry stores and stocking up on gold bars. So, you have 1.4 people doing that, even a little bit of gold bar for each person, that could definitely prop up demand for gold. And I think, as I said before, for the Chinese central bank, the rising, I think the relationship between US and China has never been worse, and is set to get probably much worse. So I think I'm going to assume that rising tension between US and China will also basically almost guarantee that the Chinese will keep diversifying away from the US dollar. And I think, into gold. Okay, so I think, from that point of view, if you want to basically buy gold right now, like your argument has to rest on what China is going to do. rather than what the US is going to do, what anybody else is going to do for that matter. And China is therefore, no question, is, I think every gold investor should really acquaint themselves with actually what's happening in gold, because that is the biggest driver of gold price lately, and likely to remain so at least in the foreseeable future.
Now, you've also talked quite a bit about oil prices, and obviously geopolitical tensions can also affect oil prices. Your take right now, it seems like oil is maybe not as high as a lot of people would expect with everything happening with respect to Israel, Hamas, and also the Ukraine-Russia war right now. But your perspective?
Yeah, I think. Listen, I think the market in general, when it comes to geopolitics, it has a very, very shallow understanding. Okay, I mean, listen. Let's put it this way. Like, I've worked on Wall Street for 20 years. Most of the traders I work with, they barely even understand economics, let alone politics or geopolitics or what's happening elsewhere and so on and so forth. What they just basically trade on headlines. Okay, obviously, oil had a big run up to $90. We're talking about Brent. Last month when Israel and Iran were trading missiles, if you recall, right? And at the time, I said that was nothing to be concerned about, because that was nothing. That was for show. Okay, even the Iranian attack on Israel in the end was basically a ceremonial attack that was prearranged by the Biden administration. The Israeli basically retaliation was such a nothing, basically, burger that, I was like laughing about this. Now, of course, since then, oil price has actually come off sharply, right? I mean, last week it had a massive drop. Last week, basically, the oil sell-off was like a 2 standard deviation move. It was a massive, basically, move. That, by the way, was a big drag on gold, too. I mean, because gold was down last week as well. And there's no doubt oil was part of it. So, I mean, it was as though that in April, everybody was talking about geopolitical risk, and all of a sudden, people sort of, woke up to the realization that geopolitical risk is not what it racked up to be between Israel and Iran. At least gold sold off and oil sold off. I actually think that this is a great opportunity to start buying oil. In fact, I bought oil, basically on Friday, last Friday, after the big drop that we saw last week. And I'm already up 1%, today. And my view is that the key here is this Israel versus Hamas, This is coming to basically the show me the money moment, if you like. What your viewer needs to understand at home is that, this war, which is now 6 months in the making, imagine you're in a football game. We're in the fourth quarter, and Hamas is leading Israel 7-3, 7-3, Hamas 7 and Israel 3. And by the way, I live in Israel, just so that you know, So Hamas 7, Israel 3, and you've got 1 more minute to go, What Hamas is trying to do right now is trying to simply run down the clock, That's what they're trying to do. They're trying to run down the clock. Israel has 1 minute to score a touchdown in order to basically win. That's the situation we're right now, Now, and I've been, if you watch my latest video, which was released on YouTube yesterday, I essentially make the case that actually we're now, the only way for Israel to score a touchdown is for Israel to go into Rafah, And I thought that there was no chance that Hamas was going to agree to a temporary ceasefire, Simply because for Hamas, they're so close to basically winning the game that the last thing they're going to do is to basically trade the hostages that they're holding, Israeli hostages, for a temporary ceasefire, which will give Israel an opportunity to attack them afterwards. So this is the reason why I thought that Hamas could potentially overplay their hand, which they did yesterday. In fact, they came out yesterday and said, they walked away from the negotiation, basically saying that, we would only, essentially trade the hostages if the U.S. guarantees that this war is over, And there is no way in hell Israel is going to accept that, because, if Hamas is still left standing at the end of this war, then this would be a huge disaster for Israel, to the extent it's going to be existential risk for Israel going forward, because Hamas wouldn't be able to rebuild. In 3 years' time, it's going to be 5 times stronger, especially with Iranian money, Iranian drones. These days, in many ways, the advent of the age of drone has eradicated, the difference between, more advanced versus less advanced armies. And I think from that point of view, Israel, to the extent, as I said to you before, Hamas just rejected the latest Israeli offer, which even Anthony Blinken had described as extraordinarily generous. I think at this point, Biden will have no choice but to begrudgingly basically give Israel the green light to go into Rafah. He might say, well, you guys have got 3 weeks to go, okay? And Israel is just going to go in. And I think that while they get ready to go into Rafah, my view is that Iran is going to have its proxies, maybe even Iran itself will be launching missiles and attacks on Israel or even on U.S. targets in the Middle East. Okay, the Houthis actually on Friday threatened that they're going to actually expand their attacks to include the Mediterranean. So my view is that the next 3 weeks are going to get very hairy. I mean, to the extent that I think that we're going to see massive intensification of attacks on Israel as Israel moves into Rafah, and it's going to feel terrible. And I think oil price definitely will be heading higher. And if that happens, gold price probably will follow higher as well.
Now, as for how this is going to be impacting the economy, it looks like oil probably heading higher in the next coming weeks. But over here in the U.S., any other major impacts that you see?
I think I'm in general short consumer discretionary because I think that high energy price and high mortgage rates are a terrible combination for U.S. consumers. And so I'm short consumer discretionary against staples, as a sort of a sector relative value trade, which I think is actually a very attractive way to express a negative view on the U.S. consumers, especially given the fact that I think I'm very bearish on Tesla in general. I think, Tesla had a, big run up in the last 2 weeks because of, the story about China doing this deal in China, which I think is all bullshit. But be that as it may, I think the whole Tesla story, which has actually, I think Tesla is about to basically to have another leg down. And I think that will, because Tesla is the biggest component of U.S. consumer discretionary index, S&P, right? So if I'm right about that, that will only reinforce this trade. So I'm definitely thinking that, the U.S. consumers are struggling right now. And especially the labor market showing some signs of softening and the Fed not being in a position to actually come to the market's rescue because of, still elevated core inflation. As a result, this is actually not a happy environment for financial markets, especially we're not officially in May, the whole, sell in May and go away. I think psychology is going to start to gain traction in the coming weeks. So we'll see how it goes. But I think, in general, I'm thinking that over the next few weeks, okay, I think, we're going to see oil price heading higher because of rising geopolitical risk. I think Russia is going to launch a major offensive as we head into the second half of May, which has been my prediction for a while. The second half of May, after the Russian Victory Day, I think the U.S. election risk is going to be going up at the same time, just when the economy starts to roll over a bit. So I'm thinking May and June will probably not be very pleasant, I think, for most risky assets.
Now, if people are interested in continuing to track all this with you, they can go to davidwoounbound.com. We'll put a link in the description. Can you share with our viewers any last thoughts and also what they'll be able to find there?
No, listen, I think what I try to do is this. Right now, just imagine that you're a retail investor, right? You put, $10,000 in the mutual fund, okay? And, in 1 week, the fund is down 5%, okay? There's nobody you can even call or even email to find out what the hell happened. They just lost 5% of your money, okay? There's no accountability whatsoever to speak of. So what I'm trying to do is that, I actually have a system. We run a portfolio, and the portfolio will tell you exactly how we're basically constructing the portfolio every week. In fact, every Sunday we do a show and tell you, okay, fine, this is what we're going to do. This is what our model says we're going to do. These are the stocks that we're going to basically buy, and so on and so forth. And then we show you our track record. I've got real money. I've got $1 million, basically invested in the strategy. And then we would more than happy to send it to anybody who wants to basically see it, the actual financial statement, because I really believe in transparency and accountability. And right now, we're benchmarked to MSCI World. So that's the broadest, global equity index. Global equity index right now is up 6% year to date, and we're up about 14%. So we're outperforming, the benchmark by a huge distance. And I don't have to tell you, typically, 85% of actively managed mutual funds underperform their benchmark. And we're not just outperforming, we're outperforming by a very big margin. Now, again, it's only 4 months, it's 4 months worth of track record because we launched this only on January 1st. And I can't guarantee that things are going to remain in the sweet spot for us. But so far, so good. But that's what I want to do, is basically the reason why I decided to take my game to YouTube, to retail investors, because I think Wall Street is too spoiled. I mean, the lack of accountability, lack of transparency really gets me, okay? And what I'm trying to do is trying to explain, make more accessible to people, things that I think ought to be easy to understand for every investor, whether you are a sophisticated institutional investor or you're less sophisticated retail investor. Because at the end of the day, the world economics, politics, geopolitics, when push comes to shove, it's not that complicated. It's not rocket science, okay? You just need to be able to explain what you're doing and trying to basically build a track record that you can, that will give you some credibility down the road. And that's what I'm trying to do.
All right. Well, David, we really appreciate your time today. Thank you so much for your time and your insights, and God bless.
Thank you so much for having me, Roger.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 29th through May 6th, 2024, while supplies last. First, we feature 2023 1-ounce South African Silver Krugerrand at just $3.10 over spot. Next, backdated 1-ounce gold Australian Kangaroos are only $59 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.